Ever pondered on what separates the world of stocks from that of cryptocurrencies? Welcome to the intriguing universe of investment, where every decision can be a stepping stone to potential financial growth. In this realm, two titans reign supreme: stocks and cryptocurrencies. These two investment vehicles drive the financial aspirations of millions around the globe, yet they are as different as night and day. Although they may seem similar on the surface, a deeper dive reveals a world of differences. Understanding these distinctions is essential for any investor, whether you're a seasoned pro or just getting started, because when it comes to your hard-earned money, knowledge is power, and that's what we're here for, to empower you with insights that can help you navigate the often turbulent waters of investment. So, buckle up and get ready for an enlightening journey. Stay tuned as we dive into the top 10 distinctions between stocks and cryptocurrencies. Both stocks and cryptocurrencies are investment vehicles, but what makes them distinct? Let's begin with stocks. Stocks represent ownership in a company. When you purchase a stock, you're essentially buying a small piece of that company. The primary purpose of investing in stocks is to share in the company's profits. As the company grows and profits, so does your investment. However, if the company's fortunes falter, your investment may decrease in value. Now let's move on to cryptocurrencies. Cryptocurrencies, on the other hand, are digital or virtual currencies that use cryptography for security. Unlike stocks, cryptocurrencies don't represent ownership in a company. They exist as tokens or coins on a blockchain network. The primary purpose of investing in cryptocurrencies is speculation. Investors buy cryptocurrencies with the hope that their value will increase over time. While the definitions of stocks and cryptocurrencies might seem straightforward, it's worth noting that the underlying mechanisms and philosophies of each are vastly different. Stocks are rooted in the physical world. They are tied to tangible companies with real products, real employees, and real profits. Cryptocurrencies, however, exist entirely in the digital realm. They are not tied to any physical entity or government, and their value is largely based on the collective belief of their users and investors. To further illustrate, let's use an analogy. Think of stocks as owning a piece of a fruit farm. The value of your investment depends on the farm's productivity and the demand for its fruits. Cryptocurrencies, on the other hand, are like owning a piece of a virtual gold mine. The value of your investment depends on the demand for this virtual gold and the belief that it holds value. In essence, both stocks and cryptocurrencies offer avenues for potential financial growth. However, they operate under different principles and serve different purposes in the world of investment. Now that we've understood their basic definitions, let's delve into the key differences. One key differentiator between stocks and cryptocurrencies lies in the realm of ownership and regulation. When you purchase stocks, you're essentially buying a piece of a company. You own a small fraction of its assets and earnings. This ownership is often represented by a stock certificate, although these days it's usually recorded electronically. It's a claim recognized by governments and enforced by laws. On the other hand, when you buy cryptocurrencies, you acquire digital tokens. This doesn't grant you ownership in a company or a claim on any physical assets. Instead, you're buying into a decentralized system. You own a piece of code stored in a digital wallet on a blockchain. This difference in ownership brings us to the second key differentiator: regulation. Stocks are heavily regulated. In the United States, for example, the Securities and Exchange Commission oversees the stock market, ensuring fairness and transparency. It's their job to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Cryptocurrencies, however, operate in a decentralized system. They're not issued or governed by a central authority. This lack of regulation has its pros and cons. On the positive side, it offers a certain level of freedom, anonymity, and potential for high returns. But it also means there's a higher risk and volatility. There's no safety net if things go south. This decentralization is both the strength and weakness of cryptocurrencies. Their value is derived from the community that supports them, and their security is maintained by a network of computers, known as miners. But without regulation, they're susceptible to market manipulation and fraud. In contrast, the regulation of stocks provides a certain level of security and predictability, but it also means there's less potential for the astronomical returns that can sometimes be made with cryptocurrencies. These differences fundamentally change the way these investments operate, but there's more to it. How do volatility and accessibility play into the differences between stocks and cryptocurrencies? You might be wondering. Well, let's dive right into it. First, let's talk volatility. If you've been keeping an eye on the financial news, you've probably heard about the wild price swings in the cryptocurrency market. One day, Bitcoin might be soaring to new heights, and the next it could be plunging. This is volatility in action. Cryptocurrencies, by their very nature, are highly volatile. They're subject to rapid and significant price movements, which can be thrilling for some and nerve-wracking for others. Stocks, on the other hand, have historically been less volatile. While they can certainly have their ups and downs, these shifts tend to be less dramatic and more predictable. This is partly due to the fact that stocks are tied to the performance of actual companies. If a company is doing well, its stock price will likely rise. If it's struggling, its stock price might fall. But these changes usually don't happen overnight. Now let's switch gears and discuss accessibility. Cryptocurrencies are, in many ways, more accessible than stocks. They operate on decentralized platforms, meaning they're not controlled by a single entity or government. This allows anyone, anywhere in the world, to buy, sell, and trade cryptocurrencies at any time. It's a round-the-clock market that never sleeps. Stocks, while accessible, are a bit more restricted. They're traded on specific exchanges during certain hours. Plus, in many cases, you'll need a broker to buy and sell stocks, and depending on where you live, you might not have access to certain stock markets. These differences in volatility and accessibility can greatly influence your investment decisions. They can affect how much risk you're willing to take on, how you approach buying and selling, and even which assets you choose to invest in. These differences can greatly affect your investment strategy. So, what's next? We're going to continue breaking down the distinctions between stocks and cryptocurrencies. Stay tuned. Transparency and security. How do these factors differentiate stocks from cryptocurrencies? Let's delve into these critical aspects. Beginning with transparency, stocks by nature are less transparent than cryptocurrencies. When you buy a stock, you're investing in a company, but the inner workings of that company are often shrouded in corporate secrecy. Sure, there are quarterly earnings reports and annual shareholder meetings, but the day-to-day operations remain largely hidden from view. On the other hand, cryptocurrencies are built on blockchain technology, an open, distributed ledger where all transactions are recorded and visible to anyone who chooses to look. This transparency can give investors a sense of confidence, knowing that every transaction is traceable and cannot be altered or deleted. Let's shift gears to security. Traditional stock markets have established and regulated security measures in place. These measures are designed to protect investors and ensure fairness in the trading process. Now, that's not to say that stock markets are impervious to fraud or manipulation, but there is a sense of security in knowing that there are regulatory bodies overseeing the process. Cryptocurrencies, being a relatively new asset class, come with a different set of security considerations. Since cryptocurrencies are digital, they are susceptible to hacking. However, the use of blockchain technology also provides a level of security. Each transaction is encrypted and linked to the previous one, making it nearly impossible to alter the transaction history. Yet, the lack of a centralized authority overseeing cryptocurrencies means that investors must take extra precautions to secure their investments. In essence, while stocks offer regulated security, cryptocurrencies provide transparency through their blockchain technology. But remember, each comes with its own set of risks and rewards. These differences are crucial in determining the risk involved in these investments. They highlight the importance of doing your own research and understanding what you're investing in fully. Whether you choose to invest in stocks or cryptocurrencies, staying informed and vigilant is key to navigating the ever-evolving world of investment. Finally, let's talk about how value determination and market hours differentiate between stocks and cryptocurrencies. For stocks, the value is primarily tied to the performance of the company. If the company does well, the stock price generally rises. Conversely, if the company struggles, the stock price may fall. Now let's contrast this with cryptocurrencies. The value of cryptocurrencies is largely driven by supply and demand. The more people want a particular cryptocurrency, the higher its price goes, and unlike stocks, it's not tied to a company's performance. Next, let's talk about market hours. Stock markets operate within business hours, typically Monday to Friday, 9 to 5. However, the cryptocurrency market never sleeps. It's open 24 hours a day, 7 days a week. This means you can buy, sell, and trade cryptocurrencies at any time. These differences underscore the unique characteristics of stocks and cryptocurrencies as investment options. So, stocks or cryptocurrencies, which one is a better fit for your investment portfolio? In this journey, we've delved into the intriguing world of investment, dissected the fundamental differences between stocks and cryptocurrencies, and examined important factors like ownership and regulation, volatility and accessibility, transparency and security, and even how their values are determined and market hours. Stocks, being traditional assets, offer stability and are regulated by financial institutions. On the other hand, cryptocurrencies, the new kids on the block, serve up high volatility, but provide unprecedented accessibility and potential for high returns. Understanding these distinctions is crucial to making informed investment decisions that align with your financial goals and risk tolerance. It's not about which is better, but about which is better for you. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notifications for updates anytime we upload a new video. Remember, we are not financial advisors, so always do your own research before making any investment decisions.